Hello, this is Chuck Carnevale, co-founder of FastGraphs, the Fundamentals Analyzer software tool. With this video, we're going to look at how FastGraphs reveals fair value on high-quality dividend growth stocks, and I'll also introduce for the first time how performance is calculated utilizing a FastGraph. My first example, I'll look at United Technologies Corp., an aerospace and defense company. Here you can clearly see that earnings growth since calendar year 1999 has averaged 9.5%. I want to point out that when you're looking at companies that grow between 5 and 15%, we're using an extrapolation of the two formulas we looked at in our first two videos. This is an extrapolation between the Graham-Dodd formula and the PEG ratio formula. And when you look at the live graph, just simply point to this and it will explain how that formula is derived. But what's really important here is to see that the price has tracked earnings per share, and every time it gets above earnings, it comes back, and every time it gets below earnings, it eventually moves back in line with earnings. And you see a period here just prior to the Great Recession where the price was tracking earnings pretty closely until the Great Recession caused a drop both in price and earnings. We see a dividend yield here of 2.4%, but we see that this company is paying out a relatively high portion of its dividends versus earnings. But the key is you can really see that the graph helps you determine when the best time to buy, sell, or hold. With our next example, we're going to look at Johnson & Johnson. What's interesting about this graph is that you can see that, since 1999 all the way up to the Great Recession, the market was pricing the stock at a premium. And we see here where the business did real well, but the price was too high, and therefore the stock price really didn't do much. And then, of course, the Great Recession came, and then all of a sudden Johnson & Johnson's stock price was trading at a discount to its fair value. In this case, the normal price-earnings ratio line is very separated because we had a period here where the price was overvalued, followed by a period where it was undervalued. Even though this is mathematically correct, I would not make a decision on the normal PE. But on the other hand, you could also argue that the market has, provided a premium valuation to this stock. At this point, I would like to go back to United Technologies and introduce our performance graph. Fair value is when the price touches the orange line. So in this case, we see an example where the price is reasonably close at the beginning and ending period. We have a 9.5% growth rate. So when we look at performance, which is the graph below, we see that this is the 15-year performance results. However, I want to point out this only includes 2 months of the 15th year. But $1,000 investment on December 31st, 1998 would have grown to $3,280.78. That's an 8.7% compounded annualized rate of return. We see that the company has not only paid a dividend, but we see that the dividend has increased every year. So in addition to the profit that we made from the price following earnings, we got an additional $534.96, which increased our return up to 9.9%. So FastGraphs automatically calculates the performance on each company based on the time frame that is being drawn. Therefore, in addition to being able to ascertain the right times to buy, sell, or hold, the FastGraphs subscriber can also measure performance for whatever time frame that they're measuring when they draw a FastGraph.